So today in the Zeus Bootcamp, we're going to talk about one of the most important topics of all trading. No matter what strategy, no matter what entry system, no matter what principles you have when it comes to entering a trade, without this, long-term success in trading is hard to come by. And that topic is risk management, one of the most important aspects of all trading. So many people overlook it because it may not be the glory of trading, but when it comes down to it, that's what creates that success that gives you that outlook of trading that you're looking for. So in this lesson, you're going to learn what is risk management, or what is position sizing, how to use the correct position size, and forex return on investment principles that help you be a long-term successful traders, and also how the professionals think and mindset on risk and reward. So what is risk management? Now, risk management refers to implementing a set of rules and measures to ensure any negative impact of a forex trade is manageable. An effective strategy requires proper planning from start to finish, because it's not a good idea to start trading and then to manage your risk as you go. The mindset of risk management, we're in the business of making money. And in order to make money, we have to learn how to manage risk, those potential losses, because in trading, no matter what you trade, how you trade, you will have losses. It's part of the entire trading journey, career. The pros have losses. Everyone has losses in trading. But the manage your loss is what keeps you winning long term. Even though this is really important, ironically, it's one of the most overlooked areas in trading. And many forex traders are just anxious to get into the market trading with no regard for their total account size. Everybody has done it at some point, but you simply, struggle when it comes to managing your account or following your disciplines. But the biggest thing is that these type of traders do is that they simply determine how much they can stomach losing in one single trade and then hit the trade button. And there's really a term for this type of investing. It's not really called investing, it's called gambling. So position sizing. Position sizing is one of the factors of risk management, one of the key factors of it. It's the term used by trading to refer to the method used for determining the size of an investment in the portfolio, aka the method used to determine how much funds should be allocated per trade. It greatly affects the purchasing power of an investor while also helping the trader improve his control of risk exposure or minimum exposure or loss. Now, the main thing is controlling that risk exposure and then aiming for maximum profits and return. It's a good idea to have a plan ahead of time before you enter the markets, before you even think about even looking at the charts. Before you do that, you should know exactly how much of a trade, how big of a trade you're trading. The reason is that you can have a big impact on not only your profit, but your risk when you do this right. So low risk, higher profits, that's what position sizing allows you to do consistently. So how to choose that correct position sizing. So the core of risk management is what this is. There's two factors to be considered when determining position sizing. They are account risk and trade risk. Now you have to take into account what type of trader you are from a risk perspective. At the end of the day, you know what you can handle or not. Trade accordingly. My number one recommendation in choosing the right position size is to never risk more than 2 to 3% trading a pair or an asset, and to never have more than 12% of your account at risk at any time. So as a rubric, what I've seen work and what I've done to make things work for my trading is, for conservative traders, if you know that you're conservative, trade that 1% max risk per pair traded. Moderate traders, 2% max per pair traded. And for aggressive traders, 3% max per pair traded. Now, no matter what, I would still stick to at least that 12% of your account at risk at any time. That's the max risk. So you don't have to trade or enter trades until you get to 12% risk. You find the trades that are acceptable to your trading plan. And if you decide to take part in those trades, follow the risk always. Follow the risk management, the position sizing that's correct for your account size always. And you'll be in a good position to where you won't blow an account off of one or two trades like many novice traders do. So we're going to go to the charts and we're going to go over the ROI principles because I think it's better if you see it on the charts than to see it in the PowerPoint. And then we're going to go over how the pros have when it comes to their mindset, when it comes to risk management, having the right mindset long term. I'm going to show you the blueprint to that. So let's take it to the charts. All right, let's go over position sizing on the charts. And the major question that you should ask yourself is what lot size should you trade with? Now that's the entire concept of position sizing. And even though it's a simple concept, a lot of people get it wrong because one, they just never been shown how to properly do it. So let's go into exactly how to do it. You can do it manually by calculating 2% of your account, but chances are, math, it could be a little bit harder. It could be more difficult just doing it manually, especially when you're in the moment of trading. So what I use is a tool that I would like to use on the web that calculates this for me. I just put in what I want to do from a risk management standpoint, and it'll show me what lot size I want. So this is the website right here. It's my FX book. And if you're going to the home area of it, all you would do is forex calculators and position size calculators. That's what will pull up this page. So let's say you're trading Euro USD and you're trading in United States dollars currencies. So you have a $5,000 account. Now, the thing is with forex, not every pair pays or risks the same amount per pip. And that's something that you'll learn as you use this as you trade for longer. For example, if you, let's go ahead and just put the 2% risk, say you're doing a 30 pip stop loss. You see here on a US dollar backed pair, a 2% risk on 30 pips would be $100. And to risk $100 on 30 pips, you would be trading a 0.33 lot size. So to illustrate this, I'm gonna keep everything else the same and just switch the pair. So we're gonna do GBP AUD. And what happens is, here we go to calculate that same, everything was different. Everything was the same as far as how much the trading account was, how much risk you was, how much stop loss. And what happened is because it's a different currency, different exchange rate that's backing this pair, that the payout is different. So to be accurate in your position sizing, it's important that you use this. You see how this is 47 versus 33. So if I go back to Euro USD, 30.33. I go to GBP AUD, 0.47. Now to keep it simple, for now, just know that whatever the second currency that's listed, that's the exchange rate is kind of going by on the back end when it comes to, for example, we're trading off of US dollars, certain calculation that happens that determines the payout. It's the same calculation all the way through, but it's just different for every pair. So if I go to one with, let's go to a different one, New Zealand dollar, Japanese yen, watch what happens. See, now it's 38. So US dollar was 0.33, Japanese yen is 0.38, and The Australian dollar was 0.47. The reason is because the payouts are a little bit different. In a later video, we'll explain this a little bit more in detail. But for now, just know that the payouts are different. So let's get back to the position sizing. So $5,000, so you're a moderate trader, 2% risk. Say you're doing a smaller trade. Maybe you're scalping. Maybe you have a tighter stop loss on your intraday trade and you decide that your stop loss is now 20 pips. So a shorter stop loss. So, right now, 2% risk on 30 pips was 0.38. Let me go ahead and hit calculate. You see now the same risk profile of 2%, but with a tighter stop loss allows you to trade with a bigger lot size because you're condensing how much 2%, how many pips 2% of your account has to cover. So let's look at this on the chart. So let's say you're looking at the market and you decide to buy here, right? Decide to buy here. Normally, based off of your entry, based off your strategy, say your entry is right here where the green and the red collide is where your entry. And we do that 30 pips. So we got 30 pips roughly. So if we're on Euro AUD, so let's go and switch this to Euro AUD. And we have 30 pips. Let's go to 30. Calculate 0.47. So the risk on all these different scenarios has stayed the same as far as the monetary risk. It's always been $100. But the lot size changes depending on what your stop loss is and what pair you're trading. It'll change between that combination. So currently at 30 pips, the lot size you'd have to use is 0.47. Let's zoom in. So that's your 30 pip stop loss. Now, rule of thumb in trading, you want to take, get it positive risk reward ratio. I know let's talk about position sizing, but risk to reward is part of position sizing. So if you're risking 30 pips, you want to at least go for 2-to-1 if possible. So 2-to-1 meaning 60 pips. So watch this. So this is 2-to-1, 30 pips. You risk $100. If you do 60 pips, that means you made $200. Remember, 2-to-1. So whatever your risk is, you multiply by 2 because it's 2-to-1. If you're able to adequately put a 20 pip stop loss, not just because it's a smaller stop loss, but there's trading reasons behind you deciding that that's an adequate stop loss, watch what happens. Now it's at $0.7 for 20 pips. So if you're at $0.7 lot size for a 20 pip stop loss and it's still $100 risk, look at what can happen. If you're doing 2-to-1, you got your 20 pip risk, move it to 20 pips, your 20 pip risk, and then on here, if you do 40 as your take profit, because remember 2-to-1, that's less pips you have to gain in order to make that 2-to-1. So if you're risking 2% and you're doing 2-to-1, what do you make in percentages? You're making 4%. What is that 4%? 200. Because remember, 2% in this scenario of risk is $100. But let's say you still go for the same 60 pips and you do a 3-to-1 trade. So meaning for every $100 on every $1 that you risk, you're getting $3. So that same 20 pips here enabled you to go 3-to-1 on what you were doing 2-to-1 on. So let's write this down. Maybe that part may confuse you. So let's put it visually. So we got 2% risk on 30 pips. That is equaling to that same $100, right? So you got $100. If you make 60 pips, let's change that. In profit, if you get 60 pips in profit, that's equal to making $200 in this example. So that's $200 or 4%. Because remember, you are a 2-to-1 reward to risk. So reward to risk. Now, what I just mentioned is that same 2% on 20 pips is also $100. But 2-to-1, your 2-to-1 reward to risk on that lot size, that one is going to be 40 pips. So because 20 pips is your risk, 40 pips is your reward that you're going for. And that 40 pips is now $200. Or 4%. Reason being is because on 2% risk 30 pips, your lot size, go back, your lot size was, I think it was 0.47. Yeah, 0.47. So on lot size. But on this trade, you're risking the same amount, but your lot size is able to be larger, 0.7%. So not percent, 0.7 lot size. So because of that lot size being bigger, but your risk not going up, when you do that 40 pips, yes, you make the same 200, but 60 pips, so 60 pips reward is what was the previous trade's target, take profit. That is equal to $300 or 6%. So that same on this trade, 60 pips is $200. On that trade, 60 pips is $300. So the name of the game is being able to find reasons to have lower stop losses, because if you can have lower stop losses, you can have better trades possibilities. Now, that this doesn't mean go put a 2 pip stop loss and trade your lot size accordingly. That's not a reasonable stop loss. But if you can find ways to have lower reasonable stop losses, that's going to help you out. The main thing here is going here to this calculator and making sure you know what your lot size is, because it's going to do all the work for you. You saw how different pairs make 2% different lot sizes, even if you don't change the account size. So make sure you use that aspect of it. The other aspect, getting into it a little bit, if you're able to create 2-to-1 risk reward ratios. So let's go back. We're getting into the pros mindset, right? Pro mindset with risk to reward, risk management in general. Is trade your plan and then trade it with consistency. So what do I mean by that? So trade your plan means to trade your risk management plan, your entry plan, but trading with consistency means to not deviate from it. These are two simple things. You think that, it's a big calculus assignment as far as how professional traders trade. It's actually the opposite. It's more simple. They know what their risk is. They know what size they're putting into their charts, and they're following their risk management plan. They understand if you have a 2-to-1. So if you have a 2-to-1 reward to risk, you think about this, right? 2-to-1 reward to risk. You place 5 trades. Let's say, to make this simple, every win you make $20. This is just hypothetical, $20. Based off your risk management, lot size, whatever. Let's just pretend that your wins is $20 based off your account size. And this is just the base of this, like the simple version of what I'm about to go over. Every loss you make or lose $10. So if you have 5 trades that win $20, that's $100 won. And you have 5 trades that lose. That lose to $10. That's $50 loss. So you are 50% accurate as a trader. But the risk management allows you that 2-to-1 risk management allows you to be profitable at 50% accuracy. And you ask yourself, why are so many traders losing if the math is really that simple and it takes so much pressure off of you? The reason is amateurs don't trade the plan, And they definitely, if they have a plan, they don't trade it with consistency. Because I'm not even, if you really think about this, I'm not even including the compounding effect to this reward to risk. Like if we go just to be a slight example, let's go and make one more box. Say your account size is $500. $500 account size. Account size, and you just did the 5 trades that won 20 and the 5 trades that lost $10. So your account is now positive $50. Plus $50 based off of that sequence. So now that account is $550. Do you think that you'll be able to have a slightly larger lot size? This probably works more with a bigger account, but a slightly larger lot size if your account is larger, but still have the same risk? Yes. So let's do this here. Let's just add $500 to this account. $500, 2%. Your same 2% risk. It was at 0.47 lots, but now you got to 550 or 5,500. Use the calculator. Now your lot size goes up because your account size is bigger, but your risk stays the same. So if you're able to stay consistent to your plan, then that's going to help you, one, be able to trade with bigger lot sizes with the right risk management over time. But then that's how you create the compounding effect, because as your account gets bigger, you're able to trade larger lot sizes. If you go on a losing streak and your account gets smaller, you trade with the smaller lot size based off that new account level, that new account value. That's the pro's mindset. That's what people don't stick to. Someone usually says, I'm going to trade with this lot size no matter what's in my account. That's the for sure way of blowing your account. You're just picking a lot size. I'm just going to trade with it no matter what my account size, no matter what my stop loss is. I'm trading with that lot size. That is an amateur's mindset. Have the pro's mindset. Keep your percentages as your account goes up or down. Keep your risk management. If you're doing 2% risk, if you get to $10,000, you're still doing 2% risk. That 2% risk is going to be bigger than your $4,000 account's 2% risk. But also, the reward would be according to that risk that you set for it. So I just wanted to go over this on the charts. I believe it's better to see it visually and to show you that website to where it can actually help you with your position sizing. So this is Keenan, the educator of Zeus, and I'll see you at the next video.